Good evening, ladies and gentlemen. We welcome you all to the first session of the FICCI Ian Startup Investment Series. The series is being organized under the FICCI for Startups initiative, to which we are providing an extensive support package to startups, connecting them with. Good evening, ladies and gentlemen. We welcome you all to the first session of the FICCI Ian Startup. Sorry, I think you can hear me now. So the series is being organized under the FICCI for Startups initiative, through which we are providing an extensive benefit package to startups, connecting them with FICCI members, mentors, investors, and also advocating their issues with the government. Within a short span of launching the FICCI for Startups initiative last year, we got 11,000 plus startups having registered for this initiative. One of the key factors that all startups wanted to hear about was in their investment decisions, whom to go to, whether to an angel, to a VC, and what are the questions and what that they should be prepared with. Today, we are honored to have with us with Ms. Padmaja Ruparel, co-founder and president of the Indian Angel Network and co-chair of FICCI Startup in Committee. Ms. Padmaja Ruparel is nationally recognized as a key player in the Indian entrepreneurial ecosystem and has helped co-found many of the relevant institutions. Padmaja Ruparel is also awarded as the top 50 most powerful women in business by Fortune India, listed in Forbes India's W Power Trailblazers and 30 most powerful women in India by Business Today. She built EAN from inception, making it within a decade a unique institution globally with close to 500 investors from 12 countries and a portfolio of over 135 companies in 7 countries spanning across 17 sectors. With this, I hand over the session to Ms. Padmaja Ruparel. In case you have any questions, you may please place them in the text box on YouTube and we'll take them one to one after the session. And before I start, I want to especially thank Ms. Padmaja Ruparel. She's not keeping well. She's down with temperature and she's having fever, but still she has agreed to do this for us today. So thank you so much, ma'am, and over to you.
Thank you, Iti. First of all, I really applaud FICCI on getting its startup committee going and creating an excellent package for startups. I am sure they will find value over the months and years. Hi, everybody. I'm sorry I'm not switching on my video. I truly don't look good today at all. As Iti mentioned, I am a little under the weather. One of the key things that entrepreneurs have come to us and asked is, when do I go to a bank? When do I go to an angel or a VC? How do I raise money? So I think instead of giving you a simple answer of saying go here or there, it's more important perhaps to explain to you the model of investing by angels or VCs, the model of investing by debt providers like banks. When you go to a debt provider, what he or she looks at is the history of the company. Hence, they would ask you 3 years P&L, 3 years balance sheet and accounts, and they look at your track record in the company and then decide to provide you loan. Number two, when they give you loan, they also assess, will you be able to pay back? So they look at your future cash flows and diligence that and see if you will build a cash flow enough to pay back the loan over the period that has been decided. Hence, debt gets repaid and it's repaid at a certain interest rate. And the provider is not taking too much of a risk. He's trying to secure his investment in your company. On the other hand, angels and VCs, they invest in the future of the company. They truly invest in what I would call startups. By definition, startups are those that do not have a history. They do not have 3 years balance sheet or P&L. What they have is a promise of becoming large. What they have is a potential with a large market and ability to harvest that market to build a top line or a revenue line, and a passion to build a large company. So angels or VCs look at the future of the company, they look at the potential of the company, and in fact, when they invest, they walk the same path of risk that the entrepreneur himself walks. Secondly, debt providers do not take any shares of the company, but equity investors do invest in the share cap of the company. So, what they look for is to buy shares in your company, and therefore, typically a significant minority, not a majority, is what good investors take, but they would become co-owners in your company. And the model of investing in return, therefore, is that they would value your company at the stage that they invest, and therefore they would buy shares at a certain value, let's say 500 bucks. And as the company grows and needs more money, or there's an acquisition or whatever, they will sell their shares at a much, much higher price. So their return on capital is basically through sale of shares. And the difference between the purchase price and the sale price is what they build as returns. The advantage of these people of taking investments from such investors is really the fact that there is really no other avenue that I know of where startups without a history can raise money. It is difficult. I don't deny it at all. Our country is just opening up its grant avenue, but how many startups really get grants? And our debt is not easily available. The only other way to build your company is by building your own revenues and plowing it back into the company. But it does need capital to even start that off. So, angel investors or VC investors are equity investors. They buy equity in your company at a certain price and at a later date sell it at a higher price. Remember, they're taking a very high risk. If you, as an entrepreneur, as a company, do not execute, do not perform, or do not build the company as promised, the investor could well lose his money. He is taking a very high risk because you, as an entrepreneur, are promising him the potential, promising him that you will achieve the projections that you talk about, and you're promising him that you will do whatever to build it. But it's a promise. Against that, the investor is performing with a check. So, this class of investors are taking the highest risk, and therefore, understandably so, they are very, very choosy. We at IAN get somewhat 12,000 to 13,000 business plans a year. We invest in 30 to 40. That's the ratio of conversion. We have to do that because it's too high a risk, and many startups do fail. Now, when you raise money from investors, what you also need to think about is apart from getting money from them, they are going to sit as co-owners. So, what value can they add beyond the check? Which is why we keep saying quality of investor is much, much more important than anything else. Sorry. These investors, if they understand the domain, they're business leaders, they've gone through the ups and downs, built garage to IPO companies, they know have been able to do turnarounds are extremely valuable for you as a company to have by your side. And if they've invested and they're a stakeholder, then they're even more engaged to help you. So raising money from quality investors is pretty much key. So it is important, and I reiterate, money and mentoring. The third thing is to understand that when investors like angels and VCs invest in shares of a company and they're looking at raising the value of the shares or getting a return as the price per share increases, remember this happens when the company grows, when the company builds a large revenue or builds IP or builds exceptional products. Hence, what is important also is that these investors typically look for companies which are catering to large market sizes. Because unless the company can create an aggressive top line, and I often say a hockey stick top line, it's very hard for share prices to increase. On the other hand, what is also important for young startups is they need to remain sustainable and they need to be able to create either profitable companies or at least have a path to profitability. So creating companies where you're very focused on cash, efficient use of cash, efficient collections from your customers, efficient credit periods and rates of credit from your suppliers, evaluating unit economics and customer acquisition costs. These are all very, very important. But to leverage all this, how can the investor help you? If it is a large market, you need connects, you need more introductions, you need credibility. As a young startup, to be honest, you don't have that. It is these investors and their background that can bring that credibility. To be known of as a company of so and so business leader opens doors right at the top. And therefore, access to large markets becomes very important. So for young entrepreneurs who are raising angel or VC money, the three words that are important when you choose your investor is money, goes without saying, mentoring for guidance and direction, and access to large markets both in India and globally. Those are the three ingredients that you can get from a high quality investor. Now, when you go to an angel investor, the question that comes up, what are the few things that investors look for when they are looking at investing in these startups? I'm going to quickly run through 5 or 6 points, and I hope those will be useful. One is market understanding. Does the set of entrepreneurs, the founders, understand the market dynamics, the market structure, the status of the market, who are the players, etc., in the sector that they are looking to play and build a business? It needs deep understanding of the domain. It needs deep understanding of how this sector plays out. What are the nuances? What works? What doesn't? Right? And yet, it has to be large and rapidly growing. So, an understanding of the market is imperative. For an even more imperative is understanding of a large market. Typically, in a large market, you will have competition. Now, competition can be defined in two ways. I'll say both, and then I'll tell you the preferred definition for me. Competition is when you're looking at two identical products and saying, mine is a little better because I have these few differentiators versus the other product. That's a very simplistic way of understanding competition. competition really needs to be understood differently. There is a problem, there is a need, and therefore you're building a solution. And when you are building a solution, you're not only looking at similar products solving the same problem, but what are the alternate solutions to solving that problem. So let me give you an example which is oft repeated and oft stated over decades. Competition between Pepsi and Coke is the first definition. What is the problem that we are solving? The problem we are solving is thirst. So one has a choice of buying Pepsi or Coke. But that's not enough. When you have a problem of thirst, you your competition is also water and other beverages. Hence, what becomes important is to understand these alternate solutions and then build your product. These alternate competing products and then build your product. Because you will not compete between a Pepsi and a Coke, but you will actually compete between your product and the world of beverages and water. So that's something you want to really, really think about. Just give me a minute. The second piece is, why are you building this proposition? Why are you building this product or solution? Right? What is the problem? Why is there a need for this solution? Because for angel investors, what is very, very important is a large market focused startup. And large markets are only created when there is a need. Hence, is the question you need to ask, is your solution, is your product, is your proposition, does it cater to a need in the market? Or is it just a nice to have? Is it a need to have or a nice to have? Right? A need to have and a nice to have. Let me give you one example. Many of you know of very elite, unique boutiques where a lot of your sisters, mothers, wives, etc., go and buy a nice, heavy wedding gown or a sharara or a ghagra. That's not a need. It's a nice to have. If I didn't have that, my life would continue, right? I'd probably wear that once in a while. It's not a need. What is a need is a shirt which I need for everyday wear. Now, the size of the market for a shirt and the size of the market for a gharara or a sharara is very different. And that is what is the difference between need to have solution and nice to have solution. If it is not need to have, equity investors like angels and VCs will step aside. Second thing, you need to be very clear. What is the stage of your solution and company? Have you just created it? Do you have a market viable product? Have you tested out the product if it needs testing? Have you done any pilots? What are your differentiators with other products? Is there a patent that you have filed or likely to file? Is there any validation? Primarily, is there anybody who's likely to either endorse the product or buy the product? That is something investors look for. They understand that they will only be able to invest and make money if there are customers who will buy the product or the solution. The third point is execution. You now understand the market. You need to figure out who is the customer, who is going to buy the product, who is the decision maker. Let me give you an example to illustrate my point. When you have a product or a toy for children, who is the decision maker? It is not the parent, it is the child. It is not the child who pays for it, it is the parent. But you need to cater to the whims, fancies, and attract the customer, in this case, which is the child. If you are selling an HR product or a solution, who is your customer? It could well be in your mind the CEO who takes all decisions, or the finance head who signs the check, or the procurement head who signs the purchase order, or is it the HR head? You need to create a partner in your customer organization to be the champion for your product. He is your client. If it is the HR person, then he is your customer. He will help you reach the point of purchase order, implementation, and finally revenues. So, understanding the customer is very important. And therefore, how will you reach the customer? Which is called the sales strategy or the customer acquisition strategy. If you are selling to a number of people, which is usually called D2C or direct to consumers or customers, strategies are very different. The element of advertisement, branding is much higher. If you are selling to enterprises, it's a very different sales strategy. So, building your customer acquisition strategies is very important. And that is where many startups fail. Be careful, because if it takes very long, you've run out of money, your product is out there in the market, and someone will copy it. You have to be able to think through the customer acquisition strategy and roll. There are always people smarter than you. If it's a product which needs after sales service, after sales support, which is also called AMC, annual maintenance contract, think about that. Those all need to be embedded in your proposition, and accordingly, you need to price the product. These are all parameters that, as investors, we would ask. They would want to know. They would want to know how deep you've gone in building these and thinking through it. You have a customer, you have a market, you have a solution, you have a strategy. None of them bring you money. The only way you bring money is by delivering the solution. Only when you deliver the product or the solution to your customer, he he is a happy, satisfied customer, will he pay. Hence, how do you build a seamless, smooth delivery operation which will bring a satisfied customer who not only buys once but comes back and buys more? That is very, very important. I cannot emphasize more that what is very important is execution, execution, execution. Ideas are a dime a dozen. It is only execution that matters. And even competing companies, you'll see world over, those which have executed well have won the game. Fourth thing is the team. When I evaluate startups, I place almost 70 to 75% of weightage to the founding team. Do they understand the domain? Do they have the passion? Will they do this irrespective of all hurdles? Do they have the leadership? Do they have the grit and the tenacity to build this venture? And do they really have a track record in this space? If the founders don't have it, we would just step away. Again, it's so critical. Second, God has not made any of us complete. None of us has the ability to do everything. So we need to build a team. As the leaders of the organization, as the founders of the organization, how will you build a team and how will you retain the team? That's a pretty big question, and a considerable amount of time is spent by investors when they talk to young entrepreneurs. Fifth is valuation. This is a topic that actually deserves a session of its own. But what is valuation? Valuation is how much do we value the company today? Which means that for the money that I am investing, let's say I'm investing 3 crores, okay, what percentage of the company am I giving? If I am given 10%, the value of the company is 27 crores. How is it 27 crores? Because the 3 crores that I give is not the value of the company, it is the value of my money. So 27 plus 3 is 30. 3 out of 30 is 10%. That's a very, very simplistic way of understanding valuation. But it's not as simple. It is based on share price, it is based on a lot of other things. But for a session like this, I think it will give you some understanding of how investors look at it. Because in a startup, there is really no formula that works. It is the value that the team brings and the value and engagement that the investor needs to put in. It is the stage at which the company is. All of these factors and more, many more, fall into the valuation discussion. What is important, however, is what is the current capital structure? Who are the shareholders today? What percentage do they hold? These are important discussions. My only request is please do two things. Never hurry this and never have a closed mind. Both of them can be lethal for your company. On the other hand, don't wait too long. The investor has many opportunities and can well walk away. So this one is a real balancing act between the entrepreneur and the investor. Financials is the sixth one. What are the current financials? What's your revenue? What are your expenses? And what are your projected revenues and expenses? But what is more important, folks, are two items. It is not P&L and balance sheet. What is critical at this stage of the company is to understand cash flow. How much money are you getting in? How much is your revenue, less expenses? How much money do investments are raised on the basis of cash flow? And cash flow is based on what is your projections. In the year 2022, what is it that you're projecting your company's revenues? As an investor, I may debate that this is too low or too high. Once we've achieved that, we work backwards to say, okay, now that we've agreed on these revenues, and can we decide how much money we need? But investments are based on cash flows. Good investors, quality investors, never underfeed a company or overfeed a company. If a company needs 3 crores, it will give it 3 crores. It will not give it 4 crores, even if the valuation is reasonable. Remember that. What is also important to be very clear that with the fundraise that you're doing, where will the company reach? Those are the milestones that your investor will track you quarter on quarter, year on year. Finally, investors do not want to be a party, do not want to be a partner in your company forever. They look to get married to you, but they want a divorce and a hefty alimony. So what they are thinking is, how will I exit? Who will buy my shares? When will somebody buy my shares? And how much return will I make? This is something you, in your pitch to investors, need to think about and bring to the fore. So to me, these are the 6 or 7 points at a very high level that angel investors or even VC investors look for. And I think most entrepreneurs should think about this irrespective of whether they are raising money or not, because they help you to build a more efficient and a robust business. Iti?
Right. Thank you, ma'am. Thank you for that very informative session. And, if you are okay, we would like to take a few questions that are coming in from the audience.
Sure.
Yeah. So we received a few questions beforehand before the session, and few are coming in live. So one question is, how old should a startup be for an angel investor to consider it for funding? So is there a time period that they need to be in business before they approach an investor?
No, we have invested in companies before they've even, we have decided to invest in companies before they've created their company. We help them to set up companies. What we need is a very clear business plan, a clear understanding of the entrepreneur's product and who's the customer. So pre-revenue companies are also invested in.
All right, thank you. The second question that came in was, what is a typical startup that an angel investor would like to invest in? So is there a preference between a manufacturing startup vis-a-vis a service startup where the returns would come more easily and faster?
I think what is important is angels invest from their personal monies, right? So um, they look for their how much money they can invest and how much can they create out of that investment. So they don't invest in high capex projects. They only invest in low capex projects. And therefore, in a manufacturing space, if there is a proposition where there's no land and building and heavy equipment, they have invested. We've invested in companies like Noka and Chakra, which are in the manufacturing space, but they don't need high volumes of money. On the service side, I think again a headcount business where the revenues is a factor of the number of heads in the business, number of people in the business. That
Right.
doesn't make it very exciting because if the number of people decrease, then the value decreases. So, from an angel investor's perspective, low capex, large market, right? And scaled up through technology. So very often I say that anything tech works for us.
Mm-hmm. That's right. All right. Thank you. The next question is, how much relevant is the funding market for a first-time entrepreneur when there are serial entrepreneurs who are looking out for funding, and it's the same guys chasing this funding? So, for how does a first-time entrepreneur flare, against maybe a second-time or a third-time founder?
No, I don't think that's the right comparison. I think each entrepreneur is got his own competencies and understanding. Repeat entrepreneurs would probably play in the same sector or domain. It is the new ones that play in the new domains.
Right. So the next question was, given the current state of the Indian economy and a focus towards self-reliance. So the next question that has been posted on YouTube is, what is the importance of Make in India or vocal for local in investor community? How are you viewing this initiative of Government of India?
Well, that's an opportunity, right? It's an opportunity for entrepreneurs to build companies here, build a supply chain, and in essence, the government is saying, let's not import, let's do as much as we can internally, right? That's one. And I think the overall innovation and the quality of entrepreneurs in the country have really risen very high quality. So it's not only Atmanirbhar that we can bring, but I think we can make Dunia Nirbhar on us.
All right. So, yeah, of course. And the next question is whether a startup should approach only one investor to begin with, or is it okay to go with multiple investors when you're raising initial amount of capital for your
So
company?
absolutely go to multiple investors.
All right. And of course,
Okay, go to
all right, all right. Multiple investors, right?
yeah, 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 yeah.
Yeah, okay. And the last question that we'll take is how can they reach angels in the angel investor network?
Through ET and FICCI.
Yeah, that's great. So, guys, we are the people, and you would have received mails from us. And in case you want to reach out to us. We'll be happy to, connect you with Ms. Padmaja Ruparil. I think, ma'am, I got one question wrong, and apologies for that. Maybe, the gentleman who asked the question is just how much relevant is founder market fit for a first-time entrepreneur when there have been exceptional founders time and again who defy FMF?
I haven't understood the question, but I think for me, a founder who understands his domain, understands his customer, understands the gap in the value chain and how his product fits, I think that's the one I would talk to.
Right. And just one last question before, which has just come in, is, the angels know how to choose their startup that they want to invest in, but how does a startup choose who's the right angel for them?
Well, there are two ways of doing it. One is do some research, talk to the angels' portfolio companies. Go on Google, you'll find who's invested in what, so you know. And secondly, if you do have competing term sheets and offers of investment, then you're lucky. But if not, I'm afraid then you'll have to do with what you get.
Right. All right. So, thank you for your session today, ma'am. And, I think there would be some entrepreneurs who are watching this today and would like to connect with you. So, we'll, do that for the startups. And once again, thank you everyone for joining in. And in case you want to reach out to us, do send an email to us. And our email IDs are given on fikiforstartups.org. You can log on to the website, and we will also post our email IDs here. You can write to us. And once again, from all of us here, ma'am, a big thanks to you, and take care, stay safe, and we hope you feel better soon.
Thank you. And thank you, everybody. Nitin, Divya, Iti. Thank you,
Thank you,
everybody.
ma'am.
Stay safe.